Welcome to the Multifamily Investor Nation podcast, sponsored by CoStar. With us today is Joseph Bramante with TriArc Properties. Joseph, welcome to the podcast.
Thank you. Glad to be here, Dan.
Well, Joseph, I'm looking forward to diving into this property. It's a unique a portfolio type of property called the Candlelight portfolio, located out of Houston, Texas. It was closed in September of 2019. It's actually a portfolio of 3 assets totaling 220 units. And looking forward to diving into this property, Joseph. But before we get started, I want you to start us off and give the listeners a little bit of a background about yourself and kind of how you got into this multifamily space.
My background's oil and gas. I started off with Exxon, did that for about 5 years, working overseas, and saved up a good bit of money and used that as my first kind of savings to purchase my first apartment complex, strictly as a hobby. And then one thing led to another. Ended up losing my job, and quickly that hobby became my full-time job. Especially with no income coming in, and now I had my property at that time wasn't doing so hot, was negative cash flowing, which unemployed plus negative cash flowing it's not a good combination. So really focused on multifamily for about 6 months and joined some local real estate groups, got a lot of education, took a lot of CCIM courses, and then met some really strategic partners who I'm partnered with still today. That really helped me turn that property around, and we went from a situation where I was about to lose all of my investment to doubling my investment, over 200% return still on the property today. And now we are, and then use that as a kind of catalyst to launch our career, our syndication career. And so we've since bought 6 other properties. This one we're talking about today is acquisition 7, 8, and 9, because it was 3 properties. And we've also kind of grown from doing strictly just owner management to also exploring fee management. So TriArc Living, which is our in-house property management company, manages all of our assets. And then also, because our backbone, we were originally a fee management company, and then I bolted on asset management to it. Now we've discovered that, we just decided to explore that. We had a lot of people asking us to manage our properties. And we were, very selective because, our core business is owner managed, but we will do fee managed for clients on a kind of to be determined basis. The other thing we launched recently is TriArc Construction, which kind of marries TriArc Living, our property management side, to the general contracting side. So we've done tons of value add rehabs. A lot of times, I think everybody knows how to do value add. They know that you can paint these things and redo the floors and whatnot and get certain returns. But actually having done it, we've done it multiple times. And marrying the property manager side with the general contracting side is what really makes a value add successful. Not just hiring a GC to give you a scope and letting him go to work. It's really the whole execution of everything that makes it successful. So we launched that in January, and now we've already got several $1 million worth of bids and work. So that's exciting. And now I'm also doing new developments. So we're breaking ground on a 240 unit complex in a tertiary market, and then we've got 2 other new developments that are kind of luxury mid-rise developments that are over existing sites that we own. That are just now starting in the planning phase. So it's, I really like the development side. It's really interesting. It's very, very long term, but it's fun because you get to create something from nothing.
Yeah. Well, let's dive into this Candlelight portfolio. This portfolio of 3 assets totaling 220 units. And let's first start off by telling us a little bit about how you actually found this property to begin with.
So we found this property just through our connections with the brokers. We've been in the Houston market. I've been in the Houston market since 2011. So we've got long-standing relationships with brokers, and they know when they get to know you, they know you have a type. Every buyer has a type, and this property just screamed us because we are known for doing these big value adds, and this one needed a huge value add. It wasn't This was by no means going to be any kind of lipstick service where you just go and paint some walls and resurface some things or anything. This was, open heart surgery, to make this deal a very successful deal. So we've gotten approached by a couple of our contacts and a couple of brokers, and we also coincidentally had a relationship with the seller. So it's kind of a notorious seller here in the Houston market, and it's kind of a badge of honor to have purchased the deal from the guy. He's a shrewd negotiator, and it was pretty fun just to go toe to toe. We weren't going toe to toe. I mean, it sounds very negative, but just to be able to get in there in the negotiating field with him and get a deal done and get it closed, because there were some moments towards the end where we didn't know if we were going to get it closed. And he was just, he was his typical self and everything you hear about. So it was just fun. You hear about personalities and whatnot in the industry, especially in your own locale, wherever you're at. And it's just fun whenever you get to actually interact with one of them in a physical, real business deal.
So with this particular one, you found out about it through the broker because it kind of had kind of typed you with, this is a perfect one that would be right up your alley. Was it a fully marketed one, or was it more of like an off-market acquisition?
No, it was fully marketed, and I think we may have gotten it. Every deal kind of goes through its cycle of, first you've got the brokers who kind of bird dog it, and they'll kind of throw it out there off market to see if they can get some bites, and then it kind of goes and then gets picked up eventually by a kind of a more mainstream broker. So I think we had gotten this one from ARA, and as soon as we had found out the purchase price and whatnot, and because we knew the seller, we knew right away what we were going to be able to get away with and what we weren't going to be able to get away with on the negotiation. So we just cut through all the BS and just gave him straight what he wanted, because we knew the guy. We knew he wasn't going to budge from his price. And we knew, so we just had to come up with a business plan around it that can justify that price. And the business plan we came up with was just this huge renovation.
So once you found out about it, at what point did you go and tour the properties?
We toured the properties, I think, the next day. One of the things that we're known for is we're quick. We see a deal, we're going to tour it, and we'll give you an offer the next day or the same day. We're not going to waste your time. And I think brokers appreciate that. They don't like to be kind of strung out and you kind of hem and haw and you maybe not, I got to check. They appreciate quick responses.
Mm-hmm. And so once you toured the property, you put the offer in the next day. How many, well, for one, do you know how many people were actually bidding on this alongside you?
No, I don't know. I don't think anybody, because we as soon as we saw it, because first ARA, they sent us the kind of teaser. And so as soon as they sent the teaser, I already knew his price, because he's got the same price for every deal he's ever sold, and which was $75 a door. That's just how he sells. It doesn't matter what the NOI says, $75 a door. And so we underwrote, and the brokers told us that was the price, and we weren't surprised when they told it to us. So we just underwrote it, and we offered, and we put in hard money, and that was the deal. So, yeah.
How many rounds of offers did you go back and forth with the seller?
Most of our back and forth was over terms. It wasn't, the price was set. We were then negotiating on terms. He had a very, his contract was very much in his favor. He had his own attorney it was his personal contract. And so that's, when you get in those situations where those bigger deals, you just, and again, you're juggling kind of risk versus probability, so as those calculations you got to make in your head of, on paper, this, if this particular thing happens, maybe I'm really kind of strung out, but the probability of that certain thing happening is extremely small or slim to none. And he was certainly pushing us to the edge of how much we could tolerate. And we got some punches in there for ourselves as well. We got some terms that were very favorable for us. But the contract was very much in his favor, and we were okay with that because we knew that we had a gold mine on our hands. So we were okay with taking more risk, more contract risk, if you will, on this deal.
On this particular acquisition, did you have to put up any earnest money deposit that went non-refundable or hard day one?
Yeah, we did. We put up hard money day one. I forget the exact amounts. We had hard money, we had extension money, and then at the very end, we were negotiating. We were slightly out of time, and we were negotiating. We negotiated a price per week extension that was hard, non-refundable, sent directly to him. So it was just basically free money. Oh no, actually, it was this was a big sticker for us. At the very end, we negotiated price per week that was sent to. Actually, I don't. It wasn't issued to him, but it went to the purchase price. So every week, our purchase price went up like $10,000.
Oh,
So
wow.
yeah, so that's never a fun situation to be in. But luckily, we closed within 4 weeks. So it 4 weeks. So it cost us an extra 40 grand. But yeah, that was a sticking point. But we knew at that point we were going to close. It was a very tough deal to get financed, which I'm sure we'll go over. But yeah, that was one of the things that we kind of got into on that one.
Sure. So this was a typical 30-day due diligence, 30 days to close with the options to extend on the backside.
Yeah, we did 30-day due diligence, 30-day close, and I think we had another 30-day extension option, and then we went beyond that.
Okay. And was that basically from the financing side of things where you had to extend it past that?
Yeah.
Yeah. Okay. So let's talk about the renovations. What was the idea on this that you were going to do and kind of move forward as far as renovations? Because I know I got a chance to kind of look at the offering on this one, and it showed that there was a little over $30,000 a door in interior renovations. I think it was like what, 36, 37, somewhere around there.
It's 37 total. About 30 just on the interior, another 7 on the exterior, plus another. I want to say it was like 1,200 a unit just in contingency. So it was actually it was more than that. Hold on, it was another 3,700 in contingency. So it was pretty well stacked on that deal. It was a big rehab. It was our biggest total capex kind of to date, but none of the actual scope items that we were doing we hadn't done before. But this was the first time that we were doing all of them together at one project. Like we've added washer and dryers before, and we've added granite counters and new roofs and all that. But this was the first actually the only thing we haven't done before on this one was plumbing. This was the first time that we're actually replacing the plumbing, which is one of those things that it's really, there's no value really in that directly. The resident can't see new plumbing, but they can certainly feel it whenever they turn the shower on. Or whenever they're turning anything on. So, and then you as the owner will feel it whenever you're not replacing or not fixing leaks every week or so. So that was one of the decisions we made. That was about $5,000 a unit just by itself for new plumbing. But yeah, it was a really big rehab. We were going in and we did everything. We did, we changed floor plans around, we moved walls, we ripped out all the cabinets, came in with new plumbing, all new floors, all new fixtures and hardware, counters. I mean, there's the only thing that was remaining in the unit is we had some of the old sheetrock, and we were leaving some of the plugs, but now we've decided to go and replace. Our maintenance guy is going to go through and replace plugs. Because it's going to cost us like $150, $200 a unit just to change out those plugs. And there's no urgency to do that, so we're going to have our maintenance team do it as we turn units and just as they get time.
So what kind of class property is this one?
So we're going to a Class A for sure. And this one, we didn't just typically on these value adds, one of the hardest parts is setting the scope. And especially for one this big. I mean, I've been doing this for a while, and even I wouldn't by myself have had the courage to do this deal if the neighboring property hadn't already done it. So we were very fortunate that there's a property a couple hundred feet down the road that did the exact or very similar renovation to what we're doing. Actually, his is a little bit higher than ours, or he at least spent more money than we did. He spent about $20,000 to $30,000 more per unit. Which really just kind of goes to our testament to how efficient we are, because we're saving quite a bit more money than he is, I think. Anyway, but he did exactly what we're doing. And whenever we shopped at local properties, the way we set our CapEx budget was I just sent the GC to that property and I said, okay, copy that property. Whatever they're doing, just give me a bid to do what that property did. And that was the original basis for our that's probably 90% of our CapEx. And then the other 15% is just stuff that's unique to us that we've kind of modified, put different stylings on, gone with a more modern, trendy look. Because with these older properties, you're not gonna, you really have to be kind of more hip and trendy than to try and really do what true Class A does, which is just, new and pretty and stuff. And ours are beautiful, but you've already got so much old architecture there that Class A doesn't have. They've got a blank slate. So you've got to take the old stuff and make it kind of hip and trendy. So that's what we did really well, we believe.
So you're basically taking this from a Class C property up to a Class A. Is that kind of what you're thinking?
This was for sure a Class D property. It was a very healthy, well, not healthy, but it was very firmly a Class D property. And we didn't realize this extent of it until we really took over. And there were units that had holes in them that hadn't been leaked. They had leaked since 2016, for 3 years. And we said, why do you have this leak? Why didn't you report this to management? They said, we did, never fixed it. And they just got used to always leaking. There's just tons and tons of issues like that. I think the month we took over, we had a $10,000 maintenance or CapEx, what do you want to call it, invoice, just from all like the little things that we had to go and fix just to get all these units up and running. Because as you know, when you take over a property, you got to give notice to all the residents, new management, and as soon as you give that notice, sure enough, you get nothing but work orders. So we just got inundated by a sea of work orders from the day we took over on that property.
So how would you classify the area? Because obviously your
area was
kind of D and A at the same time. Yeah,
the area was the biggest selling point, and it continues to do even better than we thought. Just in the past couple months, we are surrounded by brand new construction townhomes. These townhomes are between 700 and a million piece, and they're built within the last year. There's right next to one of the properties when we took over, or when we were touring it, it was just an empty lot. And now it's already fenced off. They've already got all the concrete in, and they've already built 3 or 4 houses right next to us. And the same with the other 3 properties. They're just surrounded by these really high-end homes. So it's done extremely well. Very, very.
What's the occupancy upon acquisition on these properties?
The occupancy on acquisition, we were at 90. I mean, on paper it was 95. But then once you take over and you weed out the people who aren't actually paying, it dropped down to about 85.
Okay, so about 85%. That'd be more like the economic occupancy.
Yeah, and for us, it was kind of a blessing in disguise. So we closed on the morning of the 2019th, and then there was a very minor. It was a hurricane, a Milda or depression, whatever named storm, that hit Corpus Christi and then kind of made its way east to Houston. It hit Corpus on like the 17th and made its way east to us. And so we got just a couple of bands of rain from that. And by that evening on the 19th, the property had flooded. So we lost 22 units at the moment we're taking over this whole property. We walk in and 22 units have 2 to 3 inches of water in them. So we're just like, damn it, like that sucked. I mean, good thing we had flood insurance, which we're now in a fight with because they're trying to say flood in progress. And one of the caveats when you buy a property is you can buy it and the flood insurance goes into effect that day if you close that day. But they're trying to kind of screw us out of some money because they're trying to say flood in progress. But regardless, we lost 22 units day one, so that immediately put us out another 10%. So that was, again, blessing in disguise because one, we had units to renovate, but not so good because now we were planning on those people paying their rent. So we went we're down to 75% occupied within the first couple of weeks. So that was another hurdle. Luckily, this is why you build reserves into all your models to cover situations like this. So we're sitting fine with reserves, but still, it's it wasn't a fun experience.
So, have you ever? I know you mentioned earlier on that you had done some renovations that were around that kind of $30,000 a unit kind of renovations. Have you ever done one where it's been changed from like a lower Class D property upwards to an A like this before?
Yeah, my first one actually, which was so my first deal was a 26 unit apartment complex, and I made a lot of bad decisions in the very beginning, and I got myself into a situation primarily because I didn't do the due diligence right. I mean, a lot of stuff that people know, by default now, syndication and whatnot wasn't as mainstream back then. And also I was living overseas. So for me, I was just an engineer overseas, and I read a few books, had this very high level knowledge of how to buy properties, and had, probably more money than I should have had. And and probably too much confidence. So I just went and bought a property because I said, what's the worst that could happen? Well, the worst that could happen was you buy a property that has asbestos and you don't know because you didn't do an environmental, and you end up with 150 feet of sewer line that's also crushed, and you end up buying fraudulent insurance, and you decide to start renovating 4 units and then have to stop work because you get notice that you have asbestos. So on that particular property, I was in a very dire situation after the first 6 months, and the only way to fix it was to go just throw a whole bunch of money at it and do a massive renovation, because I was in a similar situation. It was an old property, Class D, but in a great area. That one I actually had to add air conditions to because it had window units. So this one's already got ACs, fortunately. But that was the time. So on that one, I went and did a $30,000 per door all in. So that's interior and exterior. So really just interior, I think, was about $25,000 a unit. So this one per door interior is higher at 30. Yeah, we did take it from Class D to Class A. We increased rents from 540 to 1,200, leased it back up, and market value went from about 650 to 3.4 million over a 3-year period. So I was over that 3 years, I was learning and whatnot, and had a negative track record for anybody to give me money to buy future deals. Sure. Until we cashed that one out.
Sure. So one of the things that we've experienced with our group is, trying to take just a C-class property and bringing it to a B-class asset. We had some, kind of challenges when it came to turning over the resident population. And I'm curious as to how you guys mitigate that risk, because as you turn these units from a D-class property going to an A, there's a different dynamic between those two different types of resident bases. And how do you actually manage that when you have somebody who's, living next to somebody who's paying $500 in a not so good Class D property, and then somebody else who's paying, $1,200 or, $1,000 or however much more it is. That's, and of course, they having the Class A investor feeling they're not feeling safe because they're not next to another Class A type of, resident.
Yeah, Dan, you're 100% correct. That is absolutely a major problem when you're doing value adds. I experienced that on my first one, and the solution on that one was we vacated the whole property, and then we did the renovation and leased it back up. Really sucks because you have a huge carried interest because you're paying all the bills for 9 months. The solution on this one, because remember, it's 3 properties. So the solution on that one is we're doing 1 property at a time. So we're not doing all 3. So we're doing just one of the properties. We're doing the largest property right now. It was one that flooded. So we were kind of not sure which one would start in the very beginning, but then that flood made it very clear we're going to start this one. So we started that one. And so we've got very low occupancy on that particular property, but the others, our available occupancy is up at like 87% occupied across the units that are available and not down. So that's how you mitigate that. But absolutely, you can't mix Toyotas with Mercedes. They just don't go together, and those are very real reasons why they don't mix. That's the first thing that people kind of notice when they're touring a property and you're trying to get this higher end profile in, is they're going to look around at who their neighbors are, and that happens. That's the kind of human side of this business.
Yeah. Yeah, that was one of the solutions that we came up with as well. Is that, even if you have a property, you have multiple buildings, so at least just empty one building, renovate the entire building, and lease it back up, and kind of move to the next property. But it kind of sounds like that's kind of what you're doing, but emptying one entire property and then kind of going into that next property as you finish leasing up the next one.
Yeah, and then the other thing you do is you offer discounts, right? For us, I mean, we're offering a discount, but it's still a $300 increase on the previous rent. So we're okay there. But you have, it's called construction rates, where people can come in and because of all the ruckus of the rehab going on, you give them a discount. And then on those situations, you just kind of, when you're doing your qualifier, you're just trying to make sure that you might want to, for us, we increase our multiple for the income just to make sure they can afford the next rent increase.
Yeah, that makes sense. So did any issues come up during your due diligence process?
Due diligence, for us, it wasn't really, because again, we're doing
Replacing
almost
everything.
we're doing almost a $40,000 per unit renovation. So we were looking for like really big stuff, like asbestos or like something really bad, because there was really nothing that we could have seen that would have kind of deterred us or not been covered. So no, we didn't really find anything. For us, it was just we were really, our full focus was getting the rehab bid correct during that due diligence period, and making sure that it was a viable project.
So let's talk about the financing now. How did you actually finance this one and put debt on it?
We used a group out of California called LaSalle, just bridge debt. They were really great to work with. One of the issues you run into on bridge loans is they kind of do what's called a forced draw, where they force you to spend the money at a certain rate. And on a project this big, it could really get damaging if you were to go faster, or really if you were to go slower on the actual rehab than what you had thought for one reason or another. Stuff happens, and they were to start force drawing you money as if you already spent it, and then charging you interest on that loan. And so now you don't maybe have the income because you haven't renovated units. So now you've just got an increased debt service with no increase in revenue. So that's especially on a big rehab like that, it's something you're really sensitive to that. And they accommodated our that was one of the terms, is that it's like you have to accommodate our burn schedule. So other than that, I think it was just kind of your standard bridge loan. And then for us, the big issue was on the equity. We had targeted a couple of family offices for this deal, and one of the big pushbacks that we didn't anticipate was, a lot of people are looking at our purchase price versus our capex. Our capex is almost 50% of the purchase price. Well, it's actually a little bit more than 50% of the purchase price. So that's, it puts up a lot of red flags for a lot of people, particularly these family offices, where, it just seems like a very hairy, very risky deal. And we had the track record, and we can show that we've done it before, but still they weren't interested. They weren't willing to go ahead and take the bite. So we end up having 30 days prior, like really 45 days prior, we just kind of bootstrapped the whole deal and raised all the money by hand with, just kind of your normal investors, how you guys do with accredited investors. And that was, that was kind of our reason why the purchase price went up, why we got delayed, is because we just had a last minute change to raise the equity by hand.
What kind of LTV, or in this particular situation, LTC, did you get, the loan to cost?
75. Yeah, we got good LTC. The spread was good. What I didn't like was they put a floor on it, because we knew rates were falling, and I was like, come on, man, they screw you at the floor. The floor is really, the spread is nice, but you also got to pay attention to the floor, especially in this economy, because that can be a lot of money.
Yeah.
So yeah, they're making a lot of money on this deal. Everybody's going to make money on the deal, so you got to accept that. You got to let people make their money, but still, it was just, I wanted that floor lowered.
Yeah. What did you end up getting as far as the rate? Obviously it's floating, like above LIBOR or above the floor, whatever that's going to be. But what did it end up actually being like when you actually closed it?
So our spread was about 3.3, which was a little bit high. We could have gotten below 3. But the reason it was a little bit higher is because we got our burn rate, so we got a 2-year burn schedule versus everybody else was like 18 months max. So we kind of made that calculus. We're like, look, we're paying a little bit more on the spread, but we have a much longer draw schedule. So that was, that was the reason we went to that. Also, one of the things we liked about this lender was, some lenders you'll get in a situation where they do a lot of debt tests. So before you do every draw, they're giving you a debt test to make sure everything's fine, and which is good. I mean, it comes from a good. There's a reason you do that, because obviously they don't want to give you money if the property's not able to pay for itself or in dire conditions. But the problem is when you're doing that on these large value adds, is that sometimes you can get in a situation where, like for us right now, our debt coverage is fine. We're at over a 1.5 still. But if it weren't, we actually need all this money because we got those 22 flood units, plus we're at another 30 or so that are just down from vacants that we haven't backfilled because we're renovating. But, on the surface, that could look very bad, and so a lender might freak out and they might stop giving you money. And it's like, no, that's the worst thing you can do for me is you don't give me the money so I can turn these units. Because, for us, anyway, so I was going somewhere, decided to stop. But yeah, that was one of the things we liked about them. So we paid for it on the spread, but we got a good forced draw, and we got really good terms as far as the debt and the draws, and the calculation they do.
Mm-hmm. So you ended up right around about a 5% interest, kind of going into it.
Yeah,
roughly.
And they capped me at 2 floor, so.
Yeah.
2% floor. I was like, damn it. So
2%, man, they got you both ways.
Yeah, they got me both ways. So
yeah.
Actually, I think it was a 1.9, but I forget the exact term. But it was, they got us. They got us. But we got the deal, so we're happy.
Yeah.
When you sit there and you do the math, and you're like, hey, if I get this point or this position or whatever, and then you do the calculation, and your IRR moved 1/10 of a point, you're like, it doesn't make a difference. So you got to be realistic with yourself and don't, know what the true impact is of these deals and what these terms are.
Yeah. So how did you structure this deal with investors? Did you have a pref equity piece? Did you just have straight, 70-30, or did you have a preferred return, anything like that?
Yeah, we did a 70-30 with an 8 pref.
Okay. No preferred equity?
8 pref. 8 preferred equity. Oh, no, sorry, no preferred equity. No.
Yeah. Okay. So you had a preferred return, which would be that 8%, and then 70-30 after that. Any other, hurdles in the waterfall or anything?
That's it. We get their capital back, and it's 70-30.
Yeah. That's great. And how did you go about raising the capital? I know you mentioned kind of going through and trying to get in family offices to kind of get on board first, kind of, hit a brick wall there. Did you already have a list kind of had been cultivated of, private investors that you can reach out to? How did you actually end up raising that?
Yeah, so we have our mailing list that we reach out to. Then we worked with a local group here called Zeus Equity Group. They're, the owner is a good friend of mine, and we worked with them, and they brought in a bulk of the equity as well through their investors. Coincidentally, it turns out they had looked at the deal. They looked at it when it was originally off market, and had passed on it because they just couldn't get the numbers to work. It was a very hard deal to underwrite and see through, and we had the experience to renovate it. So it was, but they had the equity side. So we partnered with them, and so far everything's been great.
And how much money did you end up raising on this one?
$7.3 million.
7.3. Okay. And 7.3 million. And the purchase price on this one was right over 16, you said?
Yeah.
So roughly about 16 million. And then you put in a little over 8 million?
For the rehab?
For the rehab.
The rehab is 8.3.
Yeah, 8.3 was the rehab. Okay. All right. And how long did it end up taking you to raise the money?
30 days.
30 days. And what was the main reason that made you have to continue to extend? Because you mentioned earlier on you had to do the first 30-day extension, then you had to ask for additional
equity.
Weeks
equity,
as well.
Yeah. We had banked on this family office, and that was, that's kind of the risk you run in this industry is, we had some money already to put the deal together, and we got it secured. And we had talked to dozens of family offices to get this deal done because it's a great deal, and we just couldn't understand why they weren't doing it. We looked at all kinds of different structures and whatnot, and none of them were taken on it. And then because I think it was just too risky for them. Now that we know, at least for the offices that we were talking to, that big hairy deals like this weren't necessarily wasn't what they do. So and it was. I mean, this was a deal that, I mean, I never thought I would see another $30,000 a door renovation like my first one, because I was like, wow, that was a lot of fun. And then we saw this one at almost $40,000, and I'll probably never see another deal like this, because it's very rare that you see a deal that's been untouched, like no resurface, nothing, nada. I mean, it's basically untouched from how it was. The only thing they did was they had ceramic tile. Like that was their value add improvement, was they put ceramic tile, and they say, wow, it's value add. But anyway, yeah, that was so I think that's why. I mean, I think most offices, naturally very conservative, and they see something like this and it's not for them. So ended up having to, then with 45 days to go, we turned around and went the other way to our kind of accredited investors who have a bigger appetite for risk because it's such a high rewarding property.
And well, I'd like to kind of ask, kind of two final questions here as we wrap things up, Joseph. And first one is what was it that you found on this acquisition that originally you thought was going to be easier, but ended up being harder?
Up to the closing point, right?
Yeah.
Or post closing?
Up to the closing.
Okay. No, just the equity. That was I was like, this is a great deal. Like I just, I studied it and couldn't figure out, like, all the numbers make sense. Like everything is, I mean, it's risky. I get it. But it was rinse and repeat. Like the neighboring property had done it. Our rents were $100 less than his. Our budget was, 30 grand less than his. Or 30 grand per unit less than his. So I just couldn't understand, like, how is this deal not successful? We've got a comp next door to us. And so that was the frustration. It was getting the equity and getting the equity to see the vision and just dealing with, I guess we just kind of went to the wrong offices, I guess. I don't know. But yeah, the equity was the hardest part that I thought was going to be the easiest, because I thought I was just ringing the dinner bell with how great of a deal this was.
Well, let's talk about the other side of that question is what did you think originally was going to be harder that ended up actually being a little bit easier during this project?
The debt, surprisingly, I guess we just got lucky with the debt. I'd never heard of LaSalle before this, but our broker at Northmark had a relationship with them. We interviewed with them, or they interviewed us, however you want to look at it. And they liked our track record. They toured the property. They saw the possibility there. They 100% agreed. And so it's kind of weird, right? Like the banks are typically the most conservative, and they were like 100% on board. And then you got the equity family offices, and they were just like, we're freaking out over it. So we had the debt secured long before the equity.
Yeah. Well, we're coming up against the clock here, Joseph, and I know earlier on we mentioned we might want to try to get into some of the post-closing things that have been done. I know you guys are still kind of in the middle of renovations and things like that. What I'd like to do is maybe in the future get you back in once you've done a lot of the more of those renovations to kind of get like an update story on how this acquisition has done, and kind of bring you back for kind of like that part two, if you will, on this Candlelight portfolio.
Yeah, would love to.
Yeah. Well, why don't you share with the listeners how they can reach out to you and contact you if they have further questions about this acquisition, or maybe wanted to join you on one of your future opportunities.
Yeah. So easiest way, catch me on LinkedIn. I'm pretty active on there. Joseph Bramante, company TriArc Real Estate Partners. Also email works pretty well. info@TriArcRep, TriArcRep.com. Or you can just give me a call, 281-836-4181. But I think LinkedIn is a great tool, and I'm on there pretty actively. And we're doing also, if you want to catch some of the videos, I'm posting a lot of the videos of the rehab as it's going on LinkedIn. So we've got a really cool video coming out, a 2-part video where where I walk the test, we have 2 test units with 2 different finishes. So as we were, when you're doing this process, you want to make sure you get the correction and selections correct. So we had 2 done with different looks, and then from that we pulled and made a final version. But anyway, the video is me and the GC walking both test units. So episode 1 is test unit 1, episode 2 is test unit 2, and we go into the details about every little thing you'd want to know about this value add and the physical construction of those units and layout. So if you're interested in value adds, certainly check it out.
Awesome. Well, thank you so much, Joseph, for being with us here today, and looking forward to continue to follow you and tracking your progress, and also have you on a future episode as well.
All right. Thanks, Dan.
All right. Thanks, Joseph.